Here's a new weekly outlook for this upcoming week. Right now, the market's just opened up. We've seen a lot of big gaps with oil, gold, silver, pretty much all across the assets. So we're going to go over the fundamental analysis of why this is happening. With NASDAQ, we got a massive push up, but with the US 30, we got a big gap here. And same thing with the small caps. So let's go over the fundamental analysis of what is basically going on here, and then we'll move over to the technical side, take a look at what is happening in the equities market as well this upcoming week and how to position ourselves, because we have interest rates that will be coming out this week from the US, from the UK, and also from Japan. So starting off with some of the macro fundamentals over the weekend, what happened with the US and Iran here. We've had a lot of volatility in the markets, especially with the fundamentals this entire month. And after everything that we've covered this month with oil, especially with Brent touching around 102, the dual choke point scenario executing in real time, then Goldman's $120 scenario, and then we also saw Houthi and Saudi tankers attacks. Oil is now basically seeing a little bit more relief because of this news that we got, or development that we got over the weekend. So here we have, first of all, on Friday, we had a little bit more of a relief right when the markets were closing out, because we had Pakistan and China diplomatic initiative. And we saw that both of the countries are working jointly on working on a new framework to bring the US and Iran back to the table. China's involvement is huge here, especially with this development, and it changes the diplomatic architecture that we have been working with in a very strong, significant, and fundamental way. China imports approximately 70% of its oil through the Strait of Hormuz. So you can already guess how important this resolution is for China. And Beijing has an economic interest in reopening the strait for that very reason. When China actively intervenes diplomatically, that's not just, background supporter of Iran, but as more like an active mediator here. And the geopolitical risk premium in oil also has a credible off ramp that it didn't have about 3 days ago, or right when the market was about to close. So that gap down that we're seeing right now, especially with oil and also with a lot of these riskier assets that are all impacted by the war at the moment, that increases the probability that the dual choke point scenario is going to start to unwind here, and it increases the probability significantly. So this is not a ceasefire that's confirmed here. It is more the market pricing in a potential ceasefire becoming significantly more likely here. So when we're also looking at equities, when we're looking at US 30, or you're looking at NASDAQ that had a massive push up, with small caps here as well, S&P 500, if that's what you're trading, the equity market is basically reading oil's decline at the moment as inflationary pressure that's reducing, which means that the Fed has more room, which means that rate sensitive assets will start to recover here. So that is basic mirror picture of every session where you will see that oil will spike and equities will start to fall back down. Now, looking at the overall week, the dominant fundamental for this entire week is going to be the collision between the FOMC decision that's going to happen on Wednesday. And then on Thursday, we have Bank of England's interest rates that will be coming out. And then also, more importantly, Bank of Japan's decision that's going to be coming out, because that will be impacting all the yen pairs. And the video that I keep talking about with the USD/JPY and the unwind that's happening there, and potential unwind, and the market preparing for the intervention risk, and how that is going to impact and have a cross-asset correlation with even equities, Bitcoin, all that type of stuff. Now that is a reason why a lot of emphasis is going to be placed on BOJ's decision. And then we also have more earnings that will be coming out between Wednesday and Thursday as well. So taking a look at that, let's continue down at the very bottom, and we're going to go through all the equities in here in just a little bit too. But we have 4 of the Max 7 earnings that will be spanning between Wednesday and also on Thursday as well. So the way that these 3 events will interact with each other will determine Q3's direction for every single instrument that we're trading across the board. Now, let's start off with the Fed that is starting to get a little bit more pressure as more data points are being released. So the FOMC decision will be released on Wednesday, 11 a.m. PST or 2 p.m. Eastern time. The market right now is expecting a hold at the current interest rate levels. There's no dot plot at this meeting, which means that Warsh only has his spoken words that will be coming out at the press conference to communicate what the committee is thinking and any sort of forward, quote unquote, forward guidance, because he has very explicitly said that he doesn't believe in forward guidance and he's just following the data points. So the specific phrase that will move every single instrument simultaneously would be any mention of September combined with any implication of rate movement. What are we really expecting there? If Warsh says something that the market reads as pre-committing to a potential September rate hike, then you will see that the dollar will surge. It will gain a lot more volume. It will get a lot more strength. The yields will spike, equities will sell off, and you will see that gold will also get crushed here. If he maintains the complete data dependency with no directional signal, which is his preferred no forward guidance posture here that he has been pushing in every single public appearance so far, then the markets will see a little bit more relief there. And the focus will shift immediately to the earnings with Microsoft and Meta after the close. The critical context that he will receive at this meeting will include the jobless claims, the 187,000 that we saw, oil that has, with specifically Brent, push into $102, and with US oil pushing into the 90s area. Let's come back here. So pushing back up into the 90 and around 93 area, close to 95 almost. So he has that he's also working with, but now the gap down that we just got at potential ceasefire hopes with Google's $205 billion CapEx guide alongside Tesla's 1.4% operating margin. So all that combination with tight labor market, volatile oil, compressed tech margins, all of that gives the Fed and Kevin Warsh very specifically the legitimate reasons to say both that inflation remains a concern and that the data is mixed and we're watching it very carefully. His precise balance between those two framings is what is going to be the most important communication event when it comes to this week. And as traders, that is where we're really going to have to practice reading in between the lines. Exactly, what we have been practicing in our live sessions and market update so far. That's exactly what we're going to be doing on Wednesday as well. So we will be trading that live on YouTube. So that's going to be open to everybody. And we're going to start about 30 minutes before the interest rates are released. Now, with Thursday, we have Bank of Japan. I'm going to pull up USD-JPY because this is going to be the pair that's going to be the most volatile, but you will see a lot more volatility with GBP-JPY and Euro-JPY as well, but this is going to be the one where you're going to see a lot of whipsaws basically happening. Now, on Thursday, we have Bank of Japan's interest rates. We already had some articles come out in the past couple of weeks, basically saying that now Bank of Japan officials are considering hiking those interest rates as early as this meeting. And also that is going to have an impact on what happens with the Ministry of Finance in Japan too. Are we going to see a potential rate hike there as well? So USD-JPY is going to be one of the most dangerous instruments that I would like to say that we are going to be trading this week or we will be watching this week. It's going to be the most volatile. And when we're looking at the massive movements, and every time the last couple of weeks we've gotten news about potential intervention, we have seen massive movements. We have seen massive drops that have happened, wick rejections and all that type of stuff. So if you look at the overall chart, even on the 4-hour time frame or the daily time frame, you see that we get nice movements, but the corrective moves only happen, these big movements, only when there is news of a potential intervention. None of it has been confirmed. So every time price does break the previous highs, it just starts to consolidate. So more like a staircase kind of a movement that's happening here that we have been seeing. So that is virtually the market just pushing higher and higher because of the dollar strength against the yen over the past almost year at this point, just a continuation back up. And especially since, the war has started with US and Iran, just a massive movement to the upside, a ton of bullish momentum that's basically happening here. So we have to be careful when interest rates are released and what's going to happen with the press conference there as well. And there's only been one meaningful pullback, very specifically here from the 160 level, coming all the way back down for a much bigger movement compared to the previous retracements, where you had the top wick rejection right into that 160, came back down for almost 700 pips to the downside. We've had a pullback, even more recently too, but we don't really compare to the big movements. We only came down at most, let's say 500 pips here. So that is why, it's going to be very important to watch this pair here and watch the volatility here. And we're also seeing that it's still tapping into the current all-time highs and still trying to push and create new highs here. So the Bank of Japan is going to meet on Thursday. Now, the reason why, what happens with USD/JPY, and very specifically what happens with the yen, and why it's so important and the way that it connects to every other instrument, is that it's the carry trade, which is borrowing yen at the Bank of Japan's 1% rate to fund investments in higher yielding assets. That's the structural mechanism that has been more of a silent tailwind for the US equities, for the AI infrastructure stocks, for credit markets globally. The yen short positions are currently sitting closer to those 2007 levels. So let's pull up DXY here. So you can see that we're sitting at 40-year lows at this point, but back in 2007, 2008, even a lot lower than that. So we're sitting at the lowest point when it comes to JXY here. So the yen short positions, those are near the 2007 levels that we're looking at per the most recent positioning data points that, you can find on COT. And then also just looking at Bloomberg data points and the articles and all the analysts from the funds and the banks that they have been publishing. And Goldman Sachs revised its 12-month USD/JPY forecast to around 165. We saw an article about that too. Bank of Japan board members are saying that the policy rate should move towards 2% neutral from today's 1%. So Bank of Japan is now open to hiking faster than every 6 months. That's the article that we also looked at with Bank of Japan's new developments as of last week during our market updates and our live sessions. If Bank of Japan does deliver a surprise hike on Thursday, or let's say even a hawkish language that the market reads as a potential hike coming at the next meeting, then you will see that there's going to be a lot of volatility, and you will see that USD/JPY will drop here violently. We're potentially looking at another 400 pip drop here. The 2024 president that we're looking at here is that USD/JPY fell from the 161 levels previously and then came back down. So if you're looking at 2024 right here, this movement to the downside. So that was your 161.7 and came all the way back down into the previous supports of closer to 139 area, right? And that happened in a course of almost a month, I would say, or a couple of months here to the downside. But the most violent move in 4 months that happened was right around here. So those are the potential movements that we're looking at if price does continue to drop back down here with the BOJ hike expectations, or if there's any sort of language here. And that was when BOJ surprised the markets. So the spring is right now, kind of compressed. We're seeing that any BOJ surprise will produce the single most violent session in any instrument that you're trading against the yen across the board this week. Same thing with GBP/JPY. We haven't been trading Euro/JPY for a while, but it's the same exact thing that you're seeing here with GBP/JPY as it continues to push back up. It's doing the same exact thing, that it taps into those new highs and then starts to consolidate. You see those retracements that are happening here, but that's only happening because of those potential intervention news that we're getting, but there's no confirmation around that too. So right now we're seeing that even with GBP/JPY, we have tapped into that almost 220 area, around 219.5, and then coming back and consolidating here for the last couple of days as well. Every pip of yen strengthening that Bank of Japan surprise produces will hit GBP/JPY from both sides here. The yen strengthens and the sterling may not really be able to compensate to continue holding on to the strength here. So the most important practical guidance for GBP/JPY very specifically is going to be do not carry large GBP/JPY or USD/JPY positions going into Thursday's BOJ decision. The velocity of a surprise move in that scenario is unlike any other instrument across our board. We do trade a lot of volatile assets, US 30, gold, NASDAQ, small caps, oil, all that stuff, but just expect massive movements, right? And you don't want to be caught on the wrong side of this. Now, looking at the earnings that will be coming out, right here. You've got Apple, you have Microsoft, you have Meta, and you also have Amazon, all in one night that will be coming out this week. These 4 reports will directly answer whether Tesla and Google, the question that was raised by Tesla and Google last week. Does AI CapEx actually generate proportional revenue? And Tesla proved that it doesn't with that 1.4% operating margin on massive spending. Google proved the revenue is still there for them with 82% cloud growth. That was the main thing that we're looking at. But the free cash flow turned negative. So the market at this point has already established the template for how it responds, which is beat on revenue, miss on CapEx to free cash flow conversion. And we saw that the stock fell about 67%. Microsoft, Meta, Apple, and Amazon will report into that established template. We have been seeing that entire sell the news type of sentiment that the market has been trading off of or moving off of. The very specific metric that will dominate every single earnings that will be coming out this week is going to be more of the capital expenditure guidance for the second half of 2026 and whether management can actually articulate the revenue conversion timeline credibly here. We saw that Charles Schwab's own market strategist also said it very directly that if Google's CapEx reaction is any indicator of investor mood around heavy spending, there could be significant consequences for these names as well. The market has been sensitized to this question by what happened Thursday and Friday. So be very careful when the earnings come out, especially if you're trading NASDAQ and also US 30. And then you will see the indirect spillover happening with small caps if you're trading Russell. So that's what we have from a fundamental perspective. And then also just looking at economic data points, the main things is going to be the interest rates that come out on Wednesday. If you're trading the Aussie dollar, you do have CPI coming out, but the main focus this week is going to be preparing for the interest rates on Wednesday, interest rates on Thursday from the UK. You have advanced GDP coming out in New York session on Thursday, unemployment claims, and core PCE price index that will be coming out. And then also interest rates coming out from Japan. So Thursday is going to be quite a heavy day. And then Friday, we end off a little bit easy, just with some orange folders with CPI coming out from the Eurozone, GDP from Canada, and then consumer sentiment and inflation expectations from the US. Any questions on the fundamentals?
No question, actually. Pretty straightforward. Thank you.
So now let's come over to, let's start off with US oil first. On the weekly time frame, our first target here, same thing as last week's market update levels. We're going to map out 80, then 85, then 90, and 95. So each of these are key levels, especially based off the weekly and the monthly time frame. So you've got 85, got 90, and then also 95. So just looking at the weekly time frame or even the monthly, 85 has been a very strong support previously here back, almost a decade ago. And then after that, we've had price just holding on to this area as resistance. Once again, we had a massive spike up earlier this year in March when the war started, and it came back down and tapped right into that 80 level. If you come onto the weekly time frame, then you see a lot more consolidation around this area. We got a nice bottom wave projection last week and then a continuation back up. It becomes a lot more clear when you come onto the daily time frame, and you see that this has been a strong resistance even last year, the year prior. And then on the daily time frame, we've got a perfect break and retest here in July, and then a continuation back up. So if it does pull back down, the 80 level is still going to be held unless you get the ceasefire news. And that is when we're going to drop below the 80 level and come back down to closer to 65 level. And this is where we were right when the ceasefire was announced. And we're holding on to that ceasefire and just trying to work through some more of the other topics, like, getting Israeli forces out of Lebanon, getting that MOU pushed forward, and figuring out like some of the other sticky points. And then as soon as our ceasefire was violated, we got that massive push up above the 80, got a break and retest and a continuation back up. So right now the market is going to be, I'm anticipating giving a movement like this going into London session and even going into New York session, and just kind of holding on to the 80 level to see what happens. If we get more developments overnight that we're not getting some positive developments, we're not seeing some positive progress being made here, even with China's involvement, then we're pushing right back above that 85 level. So the gap down today really breaks that entire rally that we saw from the ceasefire being violated. Came back, corrected that almost 50% here that we're seeing. So this is going to be a very important level. If oil holds above that 84 to 85 level as the week opens up, then the ceasefire hope trade is rather going to be consolidating instead of fully unwinding the war premium here. If it breaks below this 84, 85 level, continues down closer to the 80 level, then this is going to be the next major support, which was more of our little consolidation area here, break and retest in early July. The key catalyst that will determine which way US oil will move this week will be any confirmed concrete diplomatic outcome from the China and Pakistan US Iran diplomatic push, or any new Houthi attack on Saudi tankers. Those two binary events will define US oil's direction entirely. So now you drop down to the 4-hour time frame, you have some of your levels mapped out. Let's say we get more developments on the diplomatic push that's happening here, any movements towards a potential ceasefire. You wait for price to break its own daily low, its own 4-hour low, and you take that trade down into the 80 mark. If we continue holding on to, let's say, a consolidation or anything of that sort between the 83 to 85, it is a big enough range, but I would still say just wait. I wouldn't trade this range. Rather, I would wait for price to pull back above the 85 and then a continuation back up for this gap fill from 85 closer to the 90 area. Now let's come back to, let's finish out commodities. Let's go over to gold. And with gold also, we got a gap up that has happened right when the market opened up. We have a weekly support that's being held here. You can come back up to the monthly candle as well, and pretty much sitting at all-time highs. Got a nice retracement, and last month is where we got a massive pushback down. This month, it's going to close out in about 5 days, almost 5 days, and you don't see massive movements like we have seen in the last couple of candles here. So kind of a range that we're sitting in, where of course with gold, it's always been a safe haven asset, but right now it's being pressed down because of US dollars pressure and the strength here. And we're still holding on to almost this 4,000 level as a support. So let's update this to 39.92. Market gapped up. I'm going to map out that resistance up top here, but as soon as I do that, you see the consolidation on the weekly time frame. So really just a zone-to-zone trade that we have been trading with gold for a couple of weeks now. On the daily time frame, held on to a nice support here about 2 weeks ago, and then started to push back up as of last week. And then Thursday, we pulled back down. Friday closed like a weak bullish candle, and right now it just gapped up. Dropped down to the 4-hour time frame here. So this is also going to be impacted with what happens with, the Fed and the FOMC results here. As the conflict is now evolving more from a fear event to an inflation event as well, how we talked about that with energy prices increasing and how that's going to feed directly into inflation. And now that is not just the case for the US, that's the case for every single economy across the board. And they have been impacted by that as well. With the market pricing oil spike means that the Fed is going to hike rather than, war means buy safety. And that's why we see that gold is still holding onto the support closer to the 4,000 level or just below it at the moment. So the current zone that we're looking at is just a lot of consolidation into a major support level, even from the weekly, the daily levels. And so we have to be very careful here, because as soon as we saw a little bit more relief, then gold did continue to push above that 4,000 level. And that was a very clear relief, but of course, there's still geopolitical tensions going on type of movement, but you didn't see too much pressure when it came to the US dollar here. So the FOMC and the core PCE this week are going to be two of the main catalysts that will determine gold's direction here too. I'm not mapping out any zones for gold here just yet. I want to see what happens in London session. But if we continue to see that relief, then we're headed right back up into that 4184.2 area. And those are going to be your clear buys. What I want to see is throughout Asian session and even going into London session, can we fill in that gap? Even if it's just a bottom wick, or do we leave that and the market continues pushing back up? If it does, then your clear buys are going to be as price breaks above that 4100 area, and then a continuation back up into 4184.2. If we see that, let's say there's going to be a patient Fed plus a soft PCE release, then and let's say a continued oil de-escalation, then that's going to give oil that clearest recovery path to break above that 4200 level and continue pushing closer to that 43, almost 60 area, which is your next resistance here to the upside. So that is what we're looking at. But if any of those three factors are disappointing in, let's say, a hawkish direction, then that puts more pressure on gold here, and you will see that it pulls back down closer to that 4,000 level here once again. So I'm not going to map out a zone here, a clear zone, but just for clean buys, it's going to be above 4,100. And for sells, I would wait for the entire gap fill and then a break below that previous support here on the 4-hour time frame and drop down, and you have your sells to the downside there. Now let's look at silver as well. So we had a nice peak that happened with silver back in January and then a pullback down. And then we had another peak more recently back in May, and then a continuation back down, very similar to gold. It's holding onto a weekly support. You can come back up to the monthly time frame. So even on the monthly time frame, we've had a couple of nice peaks, but then a pullback down, historically. That's kind of the same exact thing that we're looking at here at the moment. So this month as well, we've already had a bottom wick rejection into 55.3. On the weekly time frame, you have those candle closures. Last week, we've had that candle open with no bottom wick whatsoever, which tells me that the market didn't even try going bearish here. Now, the thing that differentiates silver compared to gold here is also the extraordinary level that we have been seeing with AI earnings, and especially with earnings or companies using a lot of AI, putting a lot of investment into AI. So a lot of the base or the bid that we're seeing with silver here is coming from the AI industrial demand narrative plus the war premium. And the current consolidation areas that we're also seeing across gold, and same thing with silver here, which would be right around here on the weekly time frame. Let's say 62.84. So that consolidation is basically silver attempting to find a base after that entire crash that we had from back in January and then again in May here. And the critical level here is going to be, as we drop down to the daily time frame, closer to the 60 area. So if I just create a zone here, just to show you guys, the core consolidation is really below that 60 and that 55, between that 55 area that we have here. And we're seeing that there has been multiple failed recoveries at exact this level, where price continues holding on to this area as resistance, and then you see a pullback down. If you want to narrow in your consolidation a lot more, you can create a zone right here. So really between that 60 to 57 level here. For silver to mount a genuine recovery here, it needs gold to recover first, and we will see a lot more of that volume kicking in and spilling over to silver. And it needs the AI industrial demand narrative to reassert itself after the earnings confusion that we got between Tesla and Google last week about AI capex returns. And then Intel's 25% revenue growth confirmed the demand is real. So now this week, either we're going to see Microsoft and Meta earnings confirming or complicating that story. So that's what we have for silver. This is kind of range. It's a very clear zone-to-zone trade. Same exact thing as gold. If it breaks above 60, we've got those clean buys up into the 62, almost 63 area. If it rejects that, pulls back down, then you just wait for this 4-hour support to be broken. It basically fills in that gap, and you're headed right back down into the 57.5 to almost 57 level. So commodities are going to be quite the easiest trades this entire week. Now, when we come over to indices, and we'll go over currencies in just a little bit, But when we're looking at equities, starting off with the US 30, last week we closed right down here at that 51,885 level. This week we've had a gap up. I'm not going to map out the candle open, but what I'm going to do is map out kind of that top wick rejection from last week. I'm just going to bring it just a little bit higher to sit right on top of the candle open from the week prior. So anywhere in that zone is perfectly fine. 52,580. Drop down to the daily time frame, and you see how price is currently, it tried to gap up, but it didn't gap up significantly enough that it could break these previous highs here. So that comes back to what we we're talking about earlier when it comes to the fundamental analysis and also the market sentiment analysis, that the market has optimism, but there's no confirmed ceasefire. So you're not seeing a full-on risk on sentiment here, but you're seeing a little bit more of a cautiously risk on. And that's what this looks like, that it's going to gap up into a major level, still hold on to that area as resistance and not be able to break past it just yet. But you are starting to see that, it's pulling back a little bit. But we have this entire gap here that the market has to fill in now. So on Friday, we closed down here and we had a gap up for almost 280 points right when the market opened up, right? That's very significant. And this entire month, US 30 has been the relative outperformer all month, right? And when we're looking at US 30 and you compare it to NASDAQ and you compare it to Dow, or you compare it to S&P 500 and you compare it to small caps, you see how this has been either grinding a little bit higher, or it's been flat compared to NASDAQ, which has seen a lot more crashes. Same thing with S&P 500. So those have been a little bit more, dramatic, so to speak. So here with the gap up that we just saw at the market open, and the recovery is going to be more of coming back closer to that 52,000 level at the bare minimum, and then potentially another 200-point move down into 51,885. Now you drop down to the 4-hour time frame, same exact thing. If we're going to look for sells, we're going to wait for the 4-hour lows to be broken. So if price breaks below that, then we have those sells for a continuation down. Sometimes if the sentiment is still so strong that we're looking at more of a cautiously risk on, the market will not fill in the entire gap immediately. It might fill in a little bit, grab some more orders, and on the 4-hour time frame, you can see how clearly this is a consolidation area. So just grab some orders, generate some more liquidity, and then you'll see more pushes happening, let's say closer to the New York Stock Exchange open. So that's what we have to be careful of. Just because price is dropping, you don't want to target an entire gap fill. Your entire gap fill only makes sense if price can break below that 52,100, coming back down for about 100 points into that 52,000, and then bring you down a little bit more, closer to that 51, almost 900 for a full 200-point gap fill here to the downside. The Dow strength is more structural compared to NASDAQ and S&P 500 small caps as well, because you have defense earnings that were part of US 30, which did great. And obviously they are capitalizing, and they're seeing a lot more profitability because of the war. You're also seeing a lot of energy rotation because a lot of those energy stocks are part of US 30. And of course, Apple's inclusion here as well. So it doesn't depend on the AI CapEx narrative the same way that NASDAQ does. And then if we see those continued buy opportunities, then you drop down to the 1-hour time frame and you wait for that 52,250 or almost 52,300 to be broken, and then a continuation back to the upside closer to the 52,500. Now let's come back to NASDAQ. So last week closed breaking the previous lows. So this was a very strong support level that price was holding onto, and we came back and closed just below that. This week, we opened up with no bottom wick here, obviously with that risk on sentiment, cautiously risk on, I should say. So we have that support. And for resistance, I'm going to map out this consolidation support up top here, which I would say would be more of 28,800. Now, what we're seeing here is that we've got a nice push up, but after that, the price pretty much capped out or peaked out closer to just above 30,000, almost that 30,400 area. And it was more of a zone to zone trade that we kept trading for multiple weeks here. And then finally we broke below that back in July, about 2 weeks ago. And then last week we came back and closed at the bottom of our own range here. So this has been a lot more impacted by what happened with earnings, especially with tech earnings that came out. And now we're starting to see that trying to at least stabilize a little bit more here. So the critical resistance levels that we're looking at is going to be that 29,000 almost, or even 28,800, which is that previous consolidation support. If price breaks above that, we're back into the same exact situation of a zone to zone trade, but you have almost 1,000 points or just a little bit above that you can continue trading here. For NASDAQ 100 to confirm a genuine structural reversal from this corrective moves that we are seeing on the weekly time frame, we are going to have to see that it breaks above this 28,800 and 29,000 level. Wednesday's Microsoft and Meta earnings after the FOMC decision are going to be events that will either push NASDAQ towards that resistance, or it's going to bring it back down closer to that 28,150 and potentially even a little bit lower, coming back closer to that 27, almost 600 area. If you come over to the daily time frame, basically price has now created a new lower low, trying to push back up. Friday, we opened up with no top wick, which tells me that price did not even try going bullish here. So if I were to create a zone here, I would create it right at this previous daily low or support that price is trying to break above, because we did come back down to revisit this back on July 17th. And then after that, we spent a couple of days, really until Thursday, just rejecting into the previous support areas. And Friday is really where we closed below this. And then now price is trying to push back up bullish. You come onto the 4-hour time frame, and even on Friday, basically spent the entire day just consolidating right below this 28,400 or the previous daily support levels here. So again, the FOMC decision and the Microsoft and Meta earnings, mainly those two, are going to be the main catalyst here to see which way we're headed. I would not touch NASDAQ until New York session. And then if price breaks below this, then you're coming back into consolidation. You just look for yourselves to come back down into that 28,200. But if price continues breaking past, let's say 28,600, then you have about a 200-point move at the bare minimum to come back up into 28,800. Now let's take a look at small caps, and then we'll go over to the currencies. So with small caps, with Russell 2000 here, we're seeing that we had a bit of a gap here too when the market opened up. But on the weekly time frame, we have price tapping into this previous support area into, let's just say, 2920. Pull back up already, and it's just holding onto the support area. So what I'm going to do is create a zone right here at where the market opened up, made a bottom wick, flip back up, created a top wick. So quite similar to what we just saw with NASDAQ, but a couple of weeks ago, we're sitting in this scenario with the small caps. So for the resistance, I'm going to map out right up top here, which is going to be almost at, I'm just going to say 3,000. And then if price breaks above it, then we target that 3,020 area. But 3,000 for the most part, because I do see that as price tries to break above it, it's really not able to continue pushing. It consolidates and then pulls right back down. So with the current daily candle, we got a bit of a top wick and then a gap. So this is the bottom wick that we're seeing with, it seems like, the weekly time frame here. That happened on Friday. So as price tried to break below this zone that we have closer to 2950, it wasn't able to maintain enough to continue pushing down. Instead, it just tapped into previous consolidation areas, pulled back and kind of closed right below this area. Now we have a gap up, and we're sitting into this daily consolidation here at this point. So you will see that there's going to be spillover effects from whatever happens with the US 30, whatever happens with NASDAQ, and now it's going to be coming over to Russell 2000 as well. And clearly, we're still sitting in consolidation here. We're just looking for those zone-to-zone trades. If we're looking for, so those sell opportunities, then we wait for the zone to be broken, price to continue pushing down. You fill in that gap and then potentially a little bit more. But by this point, you should already be trailing your stop loss. You should have taken your partials. This should be more of your free money type of move. If I see a rejection down here and then pull back up, we're coming right back into this consolidation here. So a confirmed daily close here, at least above this zone here, going into even tomorrow and prepping for the FOMC, is what's going to give me the confirmation that it's ready to push back up into that 3,000 level, which is going to be my clean buy opportunities here as well. The FOMC on Wednesday is also going to be a very important day for Russell 2002, because lower for longer rate expectations will reduce the floating rate borrowing costs, which puts pressure on small cap balance sheets. And that has been the specific small caps headwind all month. So that's what we're watching out for. If I drop down to the 4-hour time frame to really narrow in my zones for, let's say, even potential buy opportunities going into, let's say, London session or New York session, I'm not looking for any buys in the zone here. Now, 4 hours showing me very clear consolidation. My only buys are going to make sense above 27 or 29.70, and then a continuation back up closer to 29.85. Then the next resistance, and then that 3,000 level, which we know is a very strong level based off the weekly and the daily. If price breaks above that, we're targeting closer to the 3,000, almost 20, 30 areas, but nothing in between. Sells are only going to make sense below this. Any questions on commodities and currencies before we move on, or commodities and equities before we move on to currencies?
Nope, no questions.
Got Euro USD. So with Euro USD, we got a bit of a gap up. Once again, another asset class confirming that cautiously risk on sentiment based off of the fundamentals from over the weekend. So we have our 1.14 or 1.36. Let's just keep it at that. 1.136, which is the weekly support. You're seeing that even on the weekly time frame, we're consolidating down here. Let's come over to the daily time frame. So on the daily time frame, your core consolidation is really just right into this zone here, but that's a very small range. So I'm just going to keep it right at this level. So this is where we're going to have to be very careful. Same thing with interest rates that will be coming out. And we saw that during the Iran oil inflation panic, we have been seeing massive push back down, and that's really coming from the US dollar strength. So we have already seen that across USD/JPY, with USD/JPY grinding higher because of the dollar strength, and now we're seeing it with another currency pair with Euro USD also grinding back down because of the dollar strength. Now coming over to the 4-hour time frame, gap up, but still rejecting off of these previous consolidation support areas. So you're consolidating down here and you have consolidation right up top there, but I much rather look for candle closures above this zone and then a continuation back up, because you still get about 40 pips of a day trade out of this compared to price pushing back down. First of all, you're just looking for a gap fill, which is about 18 pips, and then a continuation down really into the previous support areas for about 28 to 30 pips, depending on your entry. So you have a little bit of a bigger range there. I'm still just looking for potential swing trade opportunities for this pair. So I'm going to wait for 1.136 to be broken and then a continuation down. If there's going to be more war escalations that will be happening, because now you get a range, much bigger range for about 90 pips, for a wick fill for about 144, and then a continuation down for 275. This is only going to happen if there's worst case scenario of no ceasefire talks whatsoever. More attacks are going to happen and a continuation down. You can already see how this pair has basically been coiling on the weekly time frame just with this pure consolidation here. So here we're basically saying that for potential recovery, we're going to need two things happening simultaneously. Oil to continue declining on ceasefire progress and reducing inflation expectations and softening the dollar, and the FOMC to basically hold without hawkish September signaling. So those conditions have to be met this week, or they could be met this week. And the ECB is holding their rates at 2.25%, while the Fed is currently sitting at 3.5%, which means that the rate differential here will structurally still favor the dollar, which is the ceiling on any Euro USD recovery, which means that at most, even if it does recover, if we do see the oil to continue declining, if we do see ceasefire progress, if we do see reducing inflation expectations, then at most Euro USD is going to be pushing back up into that 1.15 area, which in this case is still a perfect swing trade opportunity if price can break these previous highs and continue pushing back up, because you're looking at about 80 to 90 pips, potentially 100 depending on your entry, if you do end up taking an entry from down here to the top of the range for about 40 pips, and then continuation up, so about 100 pips to the upside. That is going to be the only recovery. If we see more wars, if we see that oil continues to push back up, if we don't see ceasefire progress, if we see increased inflation expectations, if we see strengthening dollar, then you're going to expect Euro USD to drop back down. Now we have GBP USD, which is sitting in this weekly consolidation here. for multiple weeks at this point. It tries to break below, really can't continue pushing besides this one time here back in October 2025, and then it retraced back up. So this entire year, for 7 months, almost 8 months at this point, price has been holding onto this 1.332 area as a very strong support level. In terms of resistance, you've got resistance up top here at 1.346. Also coiling on the weekly time frame, as you can see, just a little bit of a bigger range compared to GBP USD. And so here we saw that we got a little bit of recovery in early July, and that really came from or was driven by the UK political stabilization when Burnham replaced Starmer, and has since partially basically given back to the current consolidation that we are seeing on the weekly time frame and the daily levels here too. And we're seeing that prices continue to bounce off of these support areas, and we're going to continue to see those zone-to-zone trades that are going to be happening here. So right now, the immediate support that we're looking at is, again, that 1.332 area. If price continues pushing back up, let's say even if it gives me a bottom wick and continues pushing back up, you still have great buy opportunities given that it's a much bigger range. So it can break its own, let's say, daily high a little bit more in a continuation back up. You have about 93 pip of a range that you can look for a buy opportunity here. But right now, it is going to be capped right at that 1.1346 level. Unless we can get some more optimism, we can get some more, again, ceasefire possibilities and talks in progress that's happening here. The US dollar starts to strengthen, and we start to see a little bit of more of a strength from the GBP side. So another thing to note in terms of fundamentals here is that Burnham is hosting Zelensky at a UK naval base on Monday, which is going to be his first international visitor. And that will add a UK defense and foreign policy credibility signal that is marginally GBP positive here. The new stone cloak technology sharing with Ukraine signals that Burnham's government is willing to be, a serious NATO partner, which reduces the political uncertainty premium that is right now being priced into the sterling, or that the sterling has been dealing with, which is keeping it a little bit weaker, right? So those are the positivities or the developments that we're going to continue watching for GBP. That's going to be the same exact important fundamental when you're trading GBP, JPY as well. So those are our caps at the moment, regardless. The main thing is, what are we going to end up seeing with the US dollar? Because that is the main currency that has been driving every single asset that you're pairing it up with. So here, I'm going to drop down to the 4-hour time frame. If I can see that price is able to break past its own daily high and just a little bit more, so basically being able to break above this zone here and a continuation back up, then I have a really good buy opportunity to the upside, looking for about 90 pips depending on your entry point. You come back and you confirm that with the daily time frame here too. So you see a lot of that consolidation, break and retest support, resistance for all this consolidation. So if price breaks above that, depending on your entry, you got about 90 pips in your pocket for GBP USD. I'm not looking for sells here just yet, unless price can break below 1.332. Now let's take a look at GBP JPY on the weekly time frame. So on the weekly time frame, we're still pushing back up bullish. Last weekly candle closed weak bearish here at the moment. So it's not really giving me a full confirmed any sort of confidence that it's ready to continue pushing, but pushing back down bearish. But I do have that confirmed confidence that we might see a bit more of a push here until we get into Thursday, where the interest rates from both of these currencies will be coming out. So that is going to be my resistance at 219.6. My support is going to be the previous weekly candle's bottom wick at 217.5. Drop down to the daily time frame and you see that consolidation here. So the reason why I'm also seeing, or I have more confidence that's going to continue pushing back up bullish, is because we're starting to see a little bit more bullish momentum here as price continues holding on to this support. Every time we have bearish candle closures, as soon as price tapped into almost this 218 area, it starts to become a lot weaker compared to the bullish volume that we're seeing. I'm going to narrow in my zone a bit more for those buys to be sitting right on top of this daily consolidation. I drop down to the 4-hour time frame. You can adjust this a little bit more to sit right down here. But basically, I'm not trading in between here. If price continues pushing back up bullish, then I have this entire range of about 103 or 102 pips that I can catch or sell opportunities to the downside for about 60 pips. But either way, you have really good directional moves here. And like we mentioned when it came to the fundamentals, that every pip of yen strengthening that Bank of Japan's price produces is going to be impacting this pair from both sides simultaneously. The yen will strengthen and the sterling may not be able to compensate. So the most important thing for this pair is going to be, again, do not carry large positions going into Thursday's BOJ decision. But I am expecting that this pair will continue pushing back up bullish in preparation of that. And then depending on what we see with Bank of England's interest rates and also with Bank of Japan's interest rates, if we end up seeing those rate hikes actually happening this month, then you will see this pair drop back down closer to the 218 or even that 217.5. USD JPY also gapped down, but that mainly happened because of the US dollar softening a little bit based off the ceasefire. For this pair, you're basically sitting at all-time highs. So there's really no other resistance for you to create besides the current monthly candle or even the previous weekly high here. So in a situation like this, when price continues pushing back up bullish and there's nothing to reference to the left, I just go for a one-to-one risk to reward trade. And then from there, if I see that my one-to-one is about to hit with my profits, then I'll move to break even and then increase that one-to-one target to another one-to-one target to the upside. Right. And then I continue just doing that until I start to see some structural reversals happening on, let's say, the 30-minute or the 1 hour time frame. Now, that is my resistance at 163.9. In terms of my support, we've had a massive movement on Thursday. So what I'm going to do is map out that bottom wick rejection, or if you want, you can do this entire zone of this previous resistance here as your support into 163. Now I dropped down to the 4 hour time frame. I saw all this consolidation and the price gap down. It seems like it's trying to push back up. I'm not trading in that range. I'm only looking for buys if price can break above 163.9 and then continue pushing back up bullish from there. But do expect a lot more volatility, as we already talked about it, on the fundamental side, especially with FOMC and then also with BOJ interest rates coming out. But if price, let's say, flips back down and it breaks its own 4 hour low, then you can potentially look for a sell. Quick scalps or day trades coming back down for about 36 pips and a continuation down for about 55 pips. But if price breaks above 163.9, then we still have the active scenario of Goldman's target of potentially hitting 165 for USD JPY. So those were all the assets that we're looking at, all the assets that we'll be trading. Once again, we will have our live Wednesday trading session, but it's not going to happen right at New York Open. Like the previous weeks, we will be starting 30 minutes before interest rates are released. So you're welcome to join us on YouTube for that. And in terms of risk management, just be very careful in terms of your positioning. The guidance is going to be quite direct. We're just watching, whatever Kevin Warsh ends up saying. So today and tomorrow, or Monday and Tuesday, operate still at that 1% risk maximum while the oil gap resolves and the pre-FOMC position starts to develop here. Wednesday, very specifically, do not carry full-size positions into either the FOMC decision or after close with Microsoft and Meta print. Both events will have genuine binary outcomes. And whatever happens with Microsoft and Meta prints after close, you will see the market reacting heavily to that when the market opens up on Thursday with the New York Stock Exchange open. The FOMC press conference can move every instrument that we're looking at across the board, whether it's equities, gold, currencies, anything in either direction within, let's say, like 30 seconds, right? So size for that. Wednesday is going to be more of a day to kind of absorb and whatever's happening in the market, and then also observe, and then act on confirmed direction rather than just guessing. So when I say it's a day to absorb, it just means that look at the massive volatility in the markets, and then if you're scalping, you're going to have great opportunities there, right? But don't go into the markets already pre-positioned or just holding on to a swing trade opportunity there. So size your pairs, very specifically USD JPY, Euro JPY, and GBP JPY on Wednesday and Thursday, because Thursday carries the BOJ intervention risk. And then size those three pairs at minimum, regardless of any other conviction that you have about the dollar, right? Friday, it's going to be quite an easy day, but you still have the core PCE that's coming out this week. And if the week has been, constructive, let's say FOMC has been patient, big tech beats, BOJ is calm, A soft PCE will confirm the recovery. If any of those three will disappoint, then expect that PCE, whatever happens there, is going to amplify the downside. The single most important thing entering tomorrow's market open is going to be, does US oil hold above 83 to 84 as the Asian markets absorb whatever happens with Monday's New York session about the ceasefire news, or does it gap even lower closer to the $80 mark? So that level is going to be our reference point basically on whether the China and Pakistan diplomatic initiative is being taken seriously by the energy market. Everything else is going to be more of a downstream movement from that first signal. So make sure that you follow proper risk management. There's great opportunity this week, and the risk is equally significant. So size according to that. And I'll see you guys for the next live session. And for us, it's going to be with the simulation session that's going to happen here in just a little bit. But with everybody else, we're going to be trading live on Wednesday.